Tim, how you doing?
I'm doing great, Ryan. How are you this morning?
I'm doing great. Thanks for joining me. I really appreciate you taking time.
Happy to anytime.
So, Tim, can you do us a favor and give us a little bit of information about your background, where you've been, how you're doing now, and where you're headed?
Where I'm headed, I don't know. That's the tough part of the question. I grew up in northern Indiana, went to college, ended up working for a CPA firm for 5 years. So you've heard me say I'm a recovering CPA now. People say you never really recover from that, but it's been great background for my subsequent careers. At the ripe old age of 27, I got hired by a bank in northwest Indiana as president and CEO of a troubled bank. Got it turned around in a year, a regulatory order removed, the bank restored to profitability. And as I look back, that was kind of the start of things that led to what I've been doing for the last 30 years as an M&A advisor, investment banker. We sold the bank about a year later. I didn't like where I was going to end up. Had a chance to come to San Diego as executive vice president of a bank, which, while I was there, we grew it to the largest bank SBA lender in the country. So I became really familiar with SBA lending, which now you're the best in the business.
Well, I appreciate that.
It's great to have that connection. I was in banking here in San Diego for about 12 years. People say, well, why'd you move to San Diego from Indiana? And I say intelligence.
Absolutely.
Except on days like this where it's pretty chilly outside. But banking became kind of overregulated and wasn't very much fun. And so I met one of my former partners 30 years ago this past fall. Decided to join him. And one of the things when I learned about what it takes to get M&A transactions done for privately held companies, it's a lot of creative problem solving, and I found that's really what I had done starting in the bank turnaround for a year, where bank had a bunch of problem loans on its books, and I had to come up with a creative way to make it work for somebody. And I don't know if I've ever told you this story. One of the poster child bank loans that I got fixed was the bank had made a loan to a community group to build a swimming pool 3 years earlier, and the community group had no idea how to run a swimming pool. It had been closed for a year. It was they weren't able to make payments on the loan. It was just dead in the water. No pun intended. And I figured out the local YMCA didn't have a swimming pool, so I negotiated for the YMCA to take over the swimming pool. So then the community had a swimming pool, and the YMCA was able to start making payments on the loan. So that was the start of kind of the creative problem solving that that really led to my success in the M&A business for 30 years.
And when did you found Shoreline Partners, and talk about the genesis of Shoreline Partners?
So I met my former partner who had started the firm in 1992. He had moved down here from Spokane, Washington, Phil Curry, and really, he was by himself for a year, and this is a tough business to be a one-man show. And so I met him when we started. We were actually a branch of a Seattle firm. He'd started San Diego the same time a good friend of his started in Seattle. Quickly decided that didn't have any benefit to be connected with a Seattle firm. So 1994, shortly after I joined him, within about 3 months, we spun it off, and that was what ultimately became Shoreline Partners, LLC. Years ago.
That's wonderful. And what specifically does Shoreline Partners do?
So with one exception, in 30 years, we strictly represent the owners of privately held companies across a wide variety of industries. About the only thing we don't represent is, I say, if it's biotech and I can't understand the science involved, it's tough for me to really effectively represent them. But about 80% of what we do is sell side. When owners want to retire, exit, they're just bored. Maybe they want to take some chips off the table. Maybe they want to buy out a partner that wants to exit, and we'll have a sale engagement to sell the company or sell a minority to a majority interest in the company for a variety of reasons. And the other 20% is a combination of helping companies acquire other companies, and sometimes if a company's balance sheet is really messed up, and I know you've seen some of those as well. But I think they've got good metrics. I'll try to use all three of my hats, my CPA hat, my banking hat, and my M&A hat, to find a way to get the balance sheet fixed so then the company can go forward into the future and be successful.
That's wonderful. Talk about the process involved in a typical sales side engagement.
So I tell business owners, and I should say we generally represent companies under $100 million in revenue, so we kind of call it the lower middle market. A sale engagement from start to finish on average will take 10 to 12 months. And people say, well, man, it seems like a long time. We spend the first month in preparation, where we have a 3 to 4 hour meeting with our client, learn everything about the company. They say, well, how can you learn everything about a company in 3 to 4 hours? So I kind of use my prior CPA hat, my commercial banking hat. I learned if we go through their income statement, balance sheet, line by line, like when we're talking about sales or revenue, we learn how they sell, who they sell to, what kind of terms they offer for sales, and everything about how the revenue is generated, and then the same thing with all the rest of the lines. So the first month of preparation, our goal at the end of 30 days is to come back to our client with a written memorandum that's usually 20 to 30 pages that we take a lot of pride in. We write a narrative about our client. I'm convinced, you've heard me say this, that pitch books were invented because people can't write. And my mother was a high school English teacher before I was born, so we take pride in being good writers. We tell a compelling story about our clients, some history, what they're really good at, how they operate, opportunities for growth, and include in there some testimonials from customers that we can get. So we come back 30 days with a draft agreement like that's written, a list of prospects through our research that we want to market to. And that's unlike business brokers that will create like an online listing for business. We don't do that. We identify, typically in today's world, it can be 120 to 150 companies that we think should be interested in acquiring our client. But it's a combination of private equity groups as well as strategic companies. And then we also come back to them with what we call recast income statements. So that's taking their historical income statements and like adding back maybe personal expenses the owners have run through, or one time maybe they spent 10 grand last year on refreshing their website, but it's not something they're going to incur every year. We add all those things back. We want the income statement to look like what they would have looked like under somebody else's ownership. So once our client approves all three of those things, a memorandum, prospect list, and the income statements as we've restated them or recast them, we start out with a teaser email message to the prospects they've approved. We get an NDA signed. We think confidentiality is absolutely critical in the clients we represent. And that's the start of the marketing phase of our engagement. And I say marketing phase typically will take anywhere from 2 to 4 months. We have a hit rate of about having actual contact with around 80 to 85% of the prospect list, which is really high in this business. But it takes a lot of hard email and telephone call by our managing directors that lead that marketing phase. Our goal then is to generate multiple offers for our client so that they have choices. And I always tell them that if we had a half a dozen offers on the table, they'd be apples and peaches and pears and plums. They're all going to be how much cash up front, what kind of indemnity provisions are there? Is there an earnout? Do they want to sell or note from the seller? Do they want to provide some equity in their company as part of the currency that are going to be paid? So then we review all that stuff with our client. Who do they like? What terms do they like? And we, in a kind of a private auction setting, we get to our client says, that's the deal I like, which is the best combination of both cash as well as other terms, which are very important as well. One of the interesting things we find is that in that lower middle market that we talk about, owners really want to make sure that their employees are taken care of, especially maybe the next level of management that's been with them for a number of years. So we find that if we have 2 or 3 offers that financially are similar in a kind of a same space, our clients usually will end up taking the offer that provides the best opportunity for their employees.
That makes sense.
That's important.
Yeah.
So that marketing, so 1 month of preparation, 2 to 4 months of marketing, kind of another month to negotiate and go back and forth to our client accepts one of the letters of intent, signs that deal. In today's world, due diligence by the buyer will take often 60 to 90 days because if they've got financing, there's going to be financing done by their lender. There's going to be typically what's called a quality of earnings study that's done to support the profitability that the company's showing. And then document preparation is another 30 to 60 days. So you add those phases up, and maybe 9 months is about the fastest something's going to get done from start to finish. And it can be 12 or 13 months on the outside from start to finish.
Got it. And you mentioned it, but I'd like you to dive a little deeper into the difference between Shoreline Partners, your process, and a business broker. And then when should a company, a business owner, look to you instead of a business broker when selling their business?
So as I mentioned, a big difference is we proactively market our client to companies, that we believe should be interested in acquiring our client. They may not even be looking for somebody. Phil Curry, my former partner that started our firm, said one of our jobs is, if you're not on your computer screen for a little while, it goes black.
Yeah.
You got to jiggle the mouse or to get it to come back to life.
Yes.
Well, that's kind of our job with some prospects that aren't necessarily looking for an acquisition, but our job is to jiggle their mouse and say, you should be interested in this company because we know we have a compelling reason. When we call them, we know why they should be interested because of how it fits with that company or what they're doing or expansion they're looking for. Business brokers, on the other hand, generally take a listing, like think a real estate listing. They even call it listings, and they typically will put them on a website like bizbuysell.com is probably the most well-known one, common one. And so business brokers are good for kind of one location company. They're often described as Main Street businesses where you might have one location, a retail location or a small manufacturing company. Generally, they're going to have, $5 million or less in sales. There are some business brokers that are trying to go a little bit more upstream. So they may say, 10 to even 20 million. Generally, I'd find most business brokers probably shouldn't be representing companies that have 15 or 20 million sales, but they're good business brokers and ones that aren't so good, just like in any business. The biggest thing is kind of our process is very different. They put listings out there and they want people that are looking for acquisitions to follow up and contact them. So it's kind of an inbound. They take the inbound interest, whereas we're going out to the market and contacting companies that we believe should be interested. So that's probably the biggest difference is the process is different, and then the size of companies that we represent. We're generally larger than what business brokers do.
Wonderful. So based on your background, your experience, your time in the business, you say that you are able to obtain an unreasonable value for your clients. Can you talk to us about your specific background and how you're able to leverage that and obtain that unreasonable value? And then if you can give us an example, such as a case study that you've recently closed.
Sure. So when I started using that little tagline, people kind of chuckle, unreasonable value. What does that mean? And there are people that think of businesses kind of in this sub-$100 million revenue category. They think of them as almost commodities. It's like, well, you can take this income statement and multiply it by 3 or 5 or 10 or whatever the value multiplier might be, and that's all the market is going to pay. And I say that's complete nonsense. Again, I mentioned the memorandum we write. We tell a compelling story why somebody should be interested in our client. I think that's a real differentiator that helps to support why this company has value. We protect confidentiality. Nobody knows who our client is until after they've signed an NDA. It's a way we convey to the market that our client has value, and we're not going to show them everything until they've signed an NDA, and then even then we might limit something. The income statement recasting, a lot of companies, including I think business brokers, but even M&A advisors will say, here are the historical income statements. Here's the net income the company generated. And, we want to add back these things to it. And this is what we'd call the adjusted net income or adjusted EBITDA is a term that's used kind of in the valuation of companies like this. Well, if you show them the whole thing right up front, they're going to focus on the historical result, which is going to be less than after you've added back things that wouldn't continue under new ownership. We start with the things that, with the income statements, the way they should look to a new owner. And so we have them focused on the higher kinds of numbers. So right out of the gate, in terms of the value they're thinking about, it's based on a higher number than what a lot of other firms do. I think, too, we're good negotiators. That private auction, as I described, is a way to get a higher value because our client may say, I like offer A. I like those people, but gee, they're below the value that offer C is, but I don't really want to work with those guys. I would not want to sell my company to them. Offer A doesn't know that we want to get the deal done with them. So we go back to them and say, hey, we really like to get a deal done with you, but you're not atop the leaderboard. You got to get up here. Other thing that is a significant difference between us and business brokers always put a price on their clients. So like when you look at bizbuysell.com, here's a generic description of the company, and here's the price and what it's based on. We never do that. We don't put a price on our clients because we found that becomes a ceiling. Nobody's going to pay more than that. and it's not a floor. So we want the market to tell us where they see the value. So we ask people to make us an offer, and then that helps us see where the market is, and then we kind of negotiate up from there.
Got it. And so you do an amazing job. I've heard you tell stories of getting an unreasonable value. Tell us about what sellers can do to prepare to help leverage your expertise and get an even more unreasonable value before they get to you.
So I'll give you one story. You'd asked for a story,
Yeah,
so I'll
let's do that.
tell you one first. We sold a large distributor. When the owner engaged us, he said he and his wife had figured out the kids were grown and gone. They needed 12 to 15 million from the sale to really make it work for them for what their retirement plans are. He wasn't really ready to retire. He planned to work another 3 to 5 years for the buyer, but that's kind of the number that they needed. I reviewed his financials and I said, I think you're selling yourself short. I think it's going to be more like 18 to 20 million. So they were pretty pleased to hear that was kind of where my view of the value was. We ended up closing the transaction for 35 million.
Wow.
Just change their life, change what
Absolutely.
they could expect to do in retirement. And that was a situation where when I reviewed their financials, they were using a certain inventory accounting method, which understated their true profitability. And so I used my recovering CPA background before we went out to market to change their inventory accounting to a more acceptable level. Won't get into the details between FIFO and LIFO, but it's a big difference. And so the profitability that the owners thought they had was about half of what we went out to market with. And so we got a great value from an industry buyer that had private equity backing. And so it was just a great transaction for everybody. But the transaction closed at 3 times what the owners had said they needed. And, I call that an unreasonable value. Frankly, it was reasonable but it was using my prior CPA background to know what the buyers would be looking at in terms of the profitability of the company.
That's great.
So along those lines, I think some of the most important things for companies to do is to make sure that they have GAAP compliant financial statements. GAAP is generally accepted accounting principles. I'm often asked if they should get audited financial statements, and I say, no, you don't need audited financial statements, but your financial statements shouldn't be in accordance with GAAP. So business owners in this size range we're talking about should talk to their CPAs and ask them, are we recording revenue correctly? Are we recording expenses correctly? Because buyers, and you know this just even for SBA lending, the banks that are lending and doing those kind of getting valuations want to know that the financial statements are in accordance with GAAP. So it's worth paying a CPA firm for a company to have their financials reviewed and make sure that they are in accordance with GAAP. So I think that's a big preparation. The other one is just general corporate housekeeping. Make sure you've got all your contracts and that they're all signed, and you've got employee handbooks and just normal kind of things. Because we consistently, we'll find, we've got all the contracts, and then they can't find 2 contracts with key vendors or customers. And so it's kind of a good idea if companies even set up like an online data room that they maintain, whether it's in Dropbox or something, just keep copies of all their signed contracts and agreements in there so that when it comes time to sell, they're really ready for a buyer's due diligence and to maximize value. Because the lack of those things can cause buyers to want to reduce the price because those represent risks. Okay, here we got our largest customer, and we don't have a signed agreement with them. We got this one that we agreed to, but nobody signed it. Well, that may increase risk because now the customer has no terms they've agreed to, and if they find out the company sold, they may want to come in and renegotiate terms. So just general corporate kind of housekeeping is important.
Got it. These transactions are highly emotional for everyone, especially the seller. How do you manage the seller's emotions throughout the transaction?
That can be really tough. There have been times I have to almost play divorce counselor if the husband and wife are getting a divorce, and that's needs to sell, what's driving the sale. A big part of it is making sure they have realistic value expectations going in. And so I always ask clients before we're even engaged, what do they think the company's worth, or what are they trying to get? And if I think the company's worth $10 million and they tell me they think it's worth $20 million, then it's probably not worth me taking on the engagement. But if I think they're reasonable, I don't know. I say I can give you my estimate of where I think the value is in kind of any industry. but I'm not the one writing a check. But a lot of it is just knowing that going in, their expectations are reasonable. And then it's a matter of our process is designed so that our client will know when the deal closes that they've gotten the best value the market will produce. And a lot of us creating that competition where we have multiple offers that then we negotiate one against the other. Former partner Phil Curry always said that when he lived in Spokane, he had started and sold 2 or 3 kind of small businesses on his own to one buyer without creating competition. He always said when now he's seen what kind of increase in value you get with competition, when he thinks how much money he left on the table from the sale of his own businesses, he says he gets flu-like symptoms. Because we'll typically see anywhere from a 20 to 40% improvement in value from where the offers initially come in at to where the deal gets done. And that's, again, with competition. So we also have a saying that one buyer is no buyer. Because if you only got one buyer and nobody kind of in a backup position, as you get closer to closing, they tend to control the transaction. So they may come in 2 weeks before the transaction is supposed to close and say, oh, we're thinking more about this issue. We're going to need to reduce the price by $500,000. And if there's nobody in a backup position, if you don't have anyone else interested, the owner may say, well, okay, I still want to get the deal done. Whereas we can say to them, hey, don't start playing games with the value here because we got other people that want your seat at the table. So let's get the deal done that we agreed to.
Wonderful. And that's a perfect segue to the buyer in the transaction. Can you tell us about, because I know you've worked with a lot of buyers, can you talk to us about which buyers are typically ready, prepared to acquire these businesses? And then what type of capital do they typically raise to commence the transaction?
So I know one of the things you'd want me to talk a little bit about too is just kind of what's the San Diego market like.
Yeah.
And we all know that San Diego is not a big corporate headquarters town. So I used to say, 20 years ago that a good privately held company in San Diego had 15 or 20 million in revenue. They're bigger than that now. A good privately held company in San Diego maybe has 30, 40, maybe even 50 million revenue. That's taken biotech and some of that, much larger companies in biotech. So these are more traditional kinds of companies. So for the most part, though, companies in San Diego that are selling are probably going to be what are called add-ons for larger companies. So they're, whether it's an acquisition by an existing strategic company or a private equity group that's looking to buy something, it's generally going to be an add-on for one of their clients. So we found that for companies, let's say in the $10 to $50 million revenue range, financing for the buyer is usually not an issue because they're larger companies that either have their own bank financing available, or I'm in the middle of negotiating a transaction right now where the buyer told me earlier this week, said, we've got the cash on our balance sheet to close this transaction. Or they've got private equity backing. And the private equity groups are also ready to write a check because they got so much dry powder that needs to get invested. So generally, we don't find there are financing contingencies in transactions. Now, on the lower end of what I described, companies that are maybe in the $5 to $15 million revenue, as you know, a lot of those may have a value that are in the $3 to $7 or $8 million range, and we represent companies in that size as well. And some of those then can qualify for SBA financing. So we'll find that buyers, especially if it's a smaller kind of company where the owner is the primary one doing the buying, they'll seek SBA financing, or sometimes we'll have somebody say, "Hey, can you help us?" And so I'll refer them to you if they need SBA financing. That also then applies on some of the times when we're helping either a group of individuals or a small company acquire other companies where they may be able to use SBA financing for the bulk of the purchase.
Got it. And as far as San Diego goes, what are some of the industries that are ripe for acquisition right now?
So I would say in any economy, up, down, or sideways, manufacturing is always in demand. Manufacturing, so anybody that's doing manufacturing in San Diego or maybe manufacturing south of the border, but a lot of sales are occurring in the U.S. Anybody with manufacturing is in demand. Healthcare is everybody's looking for acquisition opportunities in healthcare companies. Again, we got an aging population, and so they see increasing need for healthcare services. And I'd say anybody that has B2B, business to business kind of offerings or revenue, that's in big demand as well. The sector that's a little soft is anybody that's selling direct to consumer, just because consumers purchasing still hasn't completely rebounded. A lot of companies going into the pandemic are still down to flat on sales. They haven't had the kind of growth that other sectors have. So they're the ones that aren't probably going to get the highest value. We've got also online retailers in San Diego that are also in demand. There are companies looking to kind of do some roll-ups of online retailers because they've got greater technology, a greater skill set to like sell through Amazon or sell directly. And so those are also in demand.
Got it. So you've been through several cycles in your lifetime. Where do you see us now in our current cycle, whatever your opinion is of where we are? And if you could put on your prognostication hat, what do you think the M&A market will look like next year, maybe even the year, maybe even the following year?
Darn, you forgot to tell me to bring my crystal ball with me, or my magic 8-ball.
There you go.
We're in a really strong market. I mean, even coming out of the pandemic, we didn't see any decline in values. And again, this smaller market, people hear a lot on TV about how the M&A market was dead, but that was for larger companies, 500 million up public companies, because people were concerned the stock market was down, the buyers were going to use their stock, it wasn't a good time. But for the size of companies we represent, where generally most of the purchase price is going to be in cash, private equity had a ton of money, strategic companies had a ton of cash, and so we didn't see a decline in value, and demand was really high. So at this point in time, I think my crystal ball would look out probably 18 months, kind of a rolling 18 months, and I don't see anything that's going to slow down. I think 2025 is going to be a huge year. We've got to continue to have lots of baby boomers that need to exit. They may have thought they would have already sold by now, but then the pandemic kind of put a little crimp in things for a while. But so now instead of being 61, they're now 65, but in good health, and they want to get going with a sale transaction. I think 25 going into the first half of 26, maybe all the way through 26 is going to be a really strong M&A year. There's still a ton of, I don't know what the number is, 2 trillion, 3 trillion, pick a number. There's plenty of cash out there looking for acquisition opportunities. So a lot of companies are saying, how do we expand what we do? And they're looking for acquisitions either to expand markets or add new products to what they're selling, or sometimes they need management. So I think it's going to be a really strong M&A period for at least the next 12 to 18 to maybe 24 months. Beyond that, I don't know. The one thing I do say, in this crazy world, we're one global event away from putting a real crimp in anything. And so that's why one of the things I learned coming through the Great Recession actually was I asked clients, do you know what you need from a sale? And they'll say, you mean what do I want? And I say, no, what you need is something different. Talk to a good wealth advisor, know what you need for your post-sale income needs. You have philanthropic objectives. Do you want to fund the kids or grandkids' college education? Know what the number is that you need. I can give you a pretty idea in this market what your value is going to be. And I say, if you have a reasonable expectation in today's market that you can get what you need from a sale, the only thing you're doing by not selling now is keeping risk. Risk of China deciding to invade Taiwan, or the Middle East blowing up, or who knows what's going to happen with Russia and Ukraine. Something crazy can happen that throws a crimp into the worldwide economy. And that can mean you might have to run your company for another 5 or 7 years. And I learned that coming through the Great Recession. Right before the recession hit, we had 2 clients here in San Diego. One had an offer from a private equity group for $31.5 million. Other had an offer from a strategic company for $27 million. Both owners declined to sell. They said, no, you know what? 18 months from now, we're going to be worth 50% more than we are today based on the growth that we're in the middle of. You know what? 18 months later, these were early 2007. 18 months later, they were both worth a third of what they were before. Wow. And those owners had to run those companies for another 5 years just to get the value back to where it was. And I hadn't understood the real question is know what you need from a sale. So I really encourage owners that are thinking about selling maybe in the next 5 years even to really work with a good wealth advisor to figure out what do you really need from a sale transaction. Because you might be better off starting a sale now, even though you were thinking about it being 5 years from now. Because if you can take care of what you need maybe you don't want to take a risk of, people are talking about a recession in 2030 or something. I don't know. Who knows? But maybe you should start a sale now to get what you need rather than punting and hoping that the market's still good by then.
Yeah, presupposing that the way it's been is the way it's going to be, and always being optimistic doesn't always necessarily prove to be true. And like you just shared with us, in fact, it could be the opposite. And not only did those companies lose value, but I think what you also hit on, which is something that can never be regained, is that those business owners lost time.
Absolutely.
Because they could have sold for the value that they were at the present, and then they would have gotten that time back. And because they didn't sell, they lost value. But more than that, they lost time. That had to have been a difficult period for them, not only knowing that their balance sheet obviously was less than it was before, but then really, practically speaking, they had to get up every single day, pull up their pants and say, not only am I worth less, but I'm still in this business.
And I got to work really hard now to recover to where we were.
To get back to even the baseline.
I think it's interesting. You think about the last 25 years, there have been 3 events that put a real crimp in the M&A market and value, starting with 9/11, and then the Great Recession, and then the pandemic. And I would guess if we fast forwarded 25 years from now, there will be at least 3 or 4 events that happened there that are beyond an owner's control. The other thing I didn't mention that I think one of the reasons we get an unreasonable value, and we also have a reputation for getting deals done, is even aside from those global events, I tell clients there are always going to be 6 or 8 clangers, we call them, in every transaction. It's going to mean something happens, something comes up in due diligence, or it's just going to kill the deal. And we're creative problem solvers. We find a solution that works for both sides, because no deal is going to close unless it's a win-win for both sides. And most business owners understand that. But if there's not somebody involved that can creatively find a way to make it work for both sides, the deal will tank. So in addition to global events, you just got normal stuff that's going to come up in a sale process. So really important for business owners to know what they need from a transaction.
Tim, thank you so much for joining me. I really appreciate it. You have a great rest of the day, and thank you again.
Yeah, thank you, Ryan. It was great talking with you as always.